Hello, everybody. Welcome to my intermediate accounting video solution walkthrough for exercise 1613. This is from Intermediate Accounting 17th edition textbook authors Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons, all rights reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky, all rights are reserved. The opinions contained within this presentation are those of myself, Bennett Tchaikovsky, and not the authors of the textbook or of Wiley. So let's get started. So right over here, we're taking a look at accounting for restricted stock. So Derrick Company issues 4,000 shares of its restricted stock to its CFO, Dane Yaping, on January 1st, 2020. The stock has a fair value of $120,000 on this date. The service period related to the restricted stock is 4 years. Vesting occurs if Yaping stays with the company for 4 years. Par value of the stock is 5. At December 31st, 2021, the fair value of the stock is $145,000. So what we're really more concerned with is what is the fair value on the date of issuance. So because this is different than stock options, meaning we're actually giving out restricted shares, we're going to be doing things a little bit differently. So when the stock is being issued on 1/1/20, we're going to be crediting out common stock par, and we'll just kind of label this as being restricted stock. This is going to be a par value of 5 times the number of shares being issued. And then the additional paid in capital common stock is going to be for 100,000. And this is going to equal the 120,000. Now, what's interesting here is because normally when we have a stock option, when we're granting stock options, we generally do not do anything when it's granted. This is different though, because we're actually giving restricted shares. So here, what we're going to use is a debit account called unearned. We're going to debit unearned compensation. Now, this is not an asset because clearly if I'm giving shares to an employee, I could never call it an asset when I'm dealing with my own stock. Just think about treasury stock. It's not a liability reduction because I'm not really reducing a liability by going through and issuing this. Rather, if we look up what is unearned compensation, what we'll find out is essentially, let's see here, what type of account? It is simply a contra-equity account. So this is essentially going to be a debit in the owner's equity section. So it's essentially going to eliminate anything right over here. So this is to record stock grant. Okay. Now, in terms of what happens at the end of the first year, so right over here on 12/31/20, even though it's not asking us to go through and to do this, let's go ahead and do it anyways. What happens at the end of the first year? Well, this has a 4-year vesting period. So what we're now going to do is we're going to debit stock compensation expense for 30,000, and we're going to go ahead and credit unearned compensation because part of this has actually been earned. So this is to record stock compensation expense. And then on 12/31/21, and again, why is this 30,000? It's 120,000 divided by 4. We're going to be doing the same journal entry on 12/31/21. Doesn't change. It's essentially going to be the same thing. The 120,000 divided by 4, this is going to be record stock compensation expense. Now, here's where we get to have some fun. So he leaves the company. Now, or he or she, not really sure, but the Yaping leaves the company. Prepare the journal entry, if any, to account for this forfeiture. So a few different things. right? If I look at my T accounts, the Ingrid's rule of T accounts, as I look over here, we have unearned compensation. And we started out with a balance of 120. We subsequently credited unearned compensation for 30 and 30. And this was in 2020, 2021. So when the forfeiture happens, the unearned compensation account has a balance of 60,000. We need to get rid of this balance, right? So what we're going to do over here is we're going to credit unearned compensation essentially to go through and to reflect that. So right over here, and this is going to be on March 4th. Okay, so we've got unearned compensation. Okay. The other thing as well is if I think about it, right, I'm not giving him the stock. So I'm going to basically pull the stock back. So over here, common stock at par, additional paid in capital common stock. We're going to go ahead and debit this for 20. We're also going to debit additional paid in capital common stock for 20. So that's how we're going to be going through and handling this part. Now, the problem is that we now have an imbalance. So what are we going to do? Now, since we are in the service period, what we're going to do is we're going to credit compensation expense. And we're going to credit compensation expense for 60 grand. This is to record forfeiture of stock options. So we're essentially reversing out, or we're getting a credit for this employee who's leaving our employ. I really have a problem. We're essentially reversing out those two entries we did up here, but that's the way they're doing it. I guess the only thing I can say is why it can kind of partially make sense, at least to me, is all this stuff is non-cash. And, you know, if you're just going to add fuel to the fire and just put in more non-cash stuff, go for it. But again, we're going to actually credit stock compensation expense because it's in the service period. If we were out of the service period, and if they decided not to, well, actually in this case, it really wouldn't matter. But if we were dealing with stock options, we would more than likely go through and just credit additional paid in capital expired stock options. But that's not what's happening here. So in any event, I want to thank you for joining me here today. I also want to thank Wiley for allowing me to use and sometimes abuse their solutions. I'm just kidding. I don't like to abuse their solutions. There's some things, and when it comes to stock compensation expense, that I have a very hard time with because this entire thing is non-cash. And you've probably heard me enough ranting, so I'm going to stop it. In any event, I want to thank Wiley for allowing me to use these solutions. Please don't forget to like and subscribe. And if you would like to see other solutions, please feel free to ask for them in the comments. Have a great day.